InvestSense market commentary for the first week of October 2025. And regular listeners probably know exactly what we're going to say next, which is markets were up another couple of percent and, reasonably calm. So-called Teflon markets shrugging off the government shutdown in the US. Maybe a few other headlines that could have been worrying, but again, it was tech that had the headlines, especially over the last couple of days with OpenAI announcing another big investment in chip company AMD, which seems to have kept the animal spirits alive. Overall, though, there's a sense that liquidity trends remain very supportive. Now, Japan is a case in point, a big move there, up almost 8% over the past week. 4-5% just in the last day or so. Now, ostensibly, that's because of fundamentally positive news, or at least for markets. So the election as LDP leader of Senai Takanaka, hopefully I got that right, is seen as essentially dovish, as an Abe protege, pro-fiscal spending, reasonably dovish, and there's a sense that she'll be looking for sort of reasonably easy policy and be pro-growth. So the markets obviously love that, the currency less so. But the other thing about that big move in Japan is quite often it happens when there's a lot of liquidity sloshing around, and it can be a bit of a bellwether in both senses of the word. So that's one of the things we were going to focus on, looking at a little bit longer term, but also as we don't have any fund managers or economists to talk to, this really is what we're working on at the moment. And it's a question we're getting a lot from clients, it's discussions we're having with Andrew Hunt about how long you stay in this rally, how comfortable are we with it, and it is in some senses a rally that's been hated by a lot of people because they don't quite understand it. It seems to be liquidity driven. That's certainly what Andrew's been talking to us about. And here are some interesting ways of looking at that. We've got a chart here from Goldman Sachs via the Marketeer, which is a subscription service, which focuses on a lot of this sentiment and liquidity stuff. And what you can see in this top bar is ETF flows by individuals compared to professional investors. Now, professional investors more and more use ETFs for rebalancing, for asset allocation, etc. But you can see these are quite big numbers, ramping up to 200 billion so far this year. And you can see the way it jumps up around April, Liberation Day, some fairly sort of contrarian buying, if you like. And that seems to have been quite supportive of markets, but especially recently, you see that slow and inexorable climb upwards. And if you compare that with the graph of what's happened for the S&P 500, for instance, here, it really does seem to mirror that. And there is a sense that maybe it's that kind of buying from the retail side that's very important now in the US. But also there's a lot of leverage flying around. Access to leverage is obviously quite widespread. There's lots of ways you can show that. But this one here shows the S&P 500, but above that, the more volatile Nasdaq 100. There's lots of leveraged ETFs, but this is also symbolic of options, one-day options, all the different ways that you can leverage into the market. And this has been, as the graph shows, a post-COVID phenomenon. So there's definitely more impact, a different market structure, which a lot of people are trying to get their minds around. Now, closer to home, we had a meeting last week with a fund manager in Australia who reflected a lot of comments that we've had from different fund managers about the liquidity structure in Australia. Now, what this is showing is it's indexed to 100, so it's showing the relative change, but it's showing this decreasing trading velocity amongst larger companies compared to smaller companies. Now, one rationale is that there's a lot of hedge funds involved in our market, but alongside that, there's a lot of money in the industry funds, as we all know. And maybe if that sort of lower turnover more and more as these funds become bigger and bigger and can't trade, the incremental impact comes from, for instance, hedge funds, or it could be others. But basically, you have this changing market structure and some quite surprising results around reporting season when you had sort of big moves in relatively large companies and an apparent lack of liquidity. So maybe that's one of the pointers. And we'll be looking a little bit more and talking to different fund managers about what that really means. But another example here that we came across just a couple of days ago. Now, this is showing ETF flows for a European ETF. And underneath that, we've mapped the relative performance of Europe versus the rest of the world. And, you have to squint a little bit, but there's probably something going on there. You can see when there's dramatic outflows, when investors are getting very worried about Europe around Liberation Day. That was probably one of the things that's, it's as much coincidental as causal. But also, if you look further on, there does seem to be some kind of a pattern. And then more recently, you've seen relative performance pick up, and you've also seen less negativity in the flows. So there is this sense that around the traps, liquidity is becoming more and more important, and market structures are changing, and we need to understand that. And we're doing a little bit of work on trying to understand that a little bit more. So there's that graph of the S&P 500. As you can see, the start of the year, markets on the back foot, sentiment really, it was the rotation trade. It seemed there was a sense that capital was flowing out of the US. Then that hiatus around Liberation Day, the recovery, and then since then, this inexorable rise. Now, if you look further back, we've got a chart here over 30 years, and, there's various times, and it's not really indicative of whether it's a good thing or a bad thing, because sometimes you have a rally like that and it just hangs around for, a few years, even though people are getting worried about the fundamentals. And now might be a time like that. And you can see that's sort of 95 after the 94 setback, and then around 98 after the Asian crisis. And markets sort of basically responded to that easing stimulus, which we think is quite germane, and we're about to get on to Andrew Hunt's thoughts on that. You can see just before the GFC, there was a similar period, a sort of great moderation, if you like, followed by the GFC, which wasn't so sort of moderate. Then in the mid-teens, after the Euro crisis, you had that same sort of very lack of volatility and rise in markets. And then there was a little bit of an upset around 2018 and then 2019. And then again, around 2020, the recovery from the COVID crisis, liquidity, stimulus, etc. Now, the point of all that is it's very difficult to time that over a few years, and that's why we're quite happy to have Andrew Hunt to help us navigate this. Now, it is, there's different ways you can look at this. This is an old quote from George Soros, who was a very valuation-driven guy, but he also really made a lot of his money when he went against his valuation instincts, and famously, even when his mind was telling him one thing, he used to say that his arthritis in his knees used to play up, and it was a sign for him to listen to his subconscious. And one of his great tricks was to participate in those late cycle rallies and then get the timing right. Now, obviously, that's a difficult thing to do. We're not suggesting anyone should try and do that. But the overall point of this quote is, when I see a bubble forming, I rush in to buy, adding fuel to the fire. So there is this, and this was even, this was 30 years ago that he made that quote. So, the world has always been thus. Sometimes there's going to be momentum, liquidity, sentiment, and you've got to make a choice. In the here and now, where we've also got a lot of focus on tracking error, for instance, your future, your super, there is a sense that you can't stray too far from the herd. But there's also, as you can see in this chart above here, there are times when maybe you do want to moderate risk. And obviously, as our clients will know, we think that there's other areas where you can maybe lean a little bit more, where there's maybe less risk, just as high expected returns, global small caps, emerging markets. But that can only take you so far. So we're not suggesting a great capitulation or that you should massively get behind this. But maybe, as Andrew's been talking to us about, not a time to take big swings because of these big liquidity flows. Another salutary lesson to show the other side of the coin. This is Chuck Prince, the erstwhile CEO of Citigroup. And, with a little bit of nervousness, we quoted him last week with his quote, which directly was, when the music stops in terms of liquidity, things will be complicated. But as long as the music is playing, you've got to get up and dance. We're still dancing. Now, he was actually out of a job not very long after that, maybe 6 months or 9 months, as Citigroup hit the rocks. They started to get credit losses. And that was kind of in early 2007, well before the GFC. However, the point that he was making was something which he'd learned throughout his career, is actually when the music is playing, normally you do have to keep dancing. As we mentioned last week, Andrew's been saying that there is a bit of a liquidity wave going on, but also importantly, he thinks the reaction function, especially as there's a slowing US economy of the current administration, is probably going to be quite stimulative. So this is something that you certainly don't want to position against. Whether you want to position for it and go overweight risk assets, that's another matter, but it's something you certainly don't want to bet against. But he does believe that that could be a problem in 2026. So that's why we're sort of staying on our toes. And the point of all this was to say we're looking at these, trying to understand the underlying liquidity dynamics so that we can better understand a lot of what's going on in markets, even if we don't necessarily have to act on it. Because basically what Andrew's saying here is you don't have to actually do a lot. But we're also staying on our toes, and this is an example of the research that he sends every week. This is the US liquidity report, and I'll just call out a couple of comments which I think are germane, which maybe give a sense of the kind of things that we're looking at. First of all, there's a sense that with the US starting to issue more debt, which they're going to have to fund the big beautiful bill, it's starting to crowd out private debt. So obviously as yields go up, and more debt is issued, that means capital that's going to fund the government, which would otherwise be going into the private sector. Now that can lead to a vicious circle because if the banks are lending less and there's lack of access to credit, you've seen a few bankruptcies in the US where companies have sort of run out of time and run out of funding mechanisms, that can lead to a vicious cycle. But the reaction function, he thinks, is that not only will the government look to stimulate past that and provide more liquidity, they've replenished their sort of checking account, the Treasury General account, they've got a little bit of ammunition there, but also there's continued flows from outside of the US into the US that doesn't seem to be stopping, and that will prop things up for the foreseeable future. So you have these opposing forces of a gently slowing US economy, but also more stimulus, more fiscal ease, and also potentially more monetary easing, which is actually quite supportive of markets. And that in a nutshell is why, despite some worrying things out there, relatively high valuations, we don't necessarily think that you have to do an awful lot in asset allocation terms at the moment, but it maybe gives a sense of the sort of things that we're watching out for. Now, obviously, this isn't personal advice, it's aimed at advisors, and we're not really making a market call here either. We're just saying that there's a lot of liquidity sloshing around and very difficult to predict where things go next. So you might as well watch very carefully and stay invested in the meantime, which is probably what you want to do most of the time. And if Andrew thinks things are getting a little bit more exciting, we'll be sure to let you know. And in the meantime, we'll keep on digging around this market structure stuff. And if it's interesting, we'll talk about that another time. Thank you.